We had Federal Bank reporting its numbers yesterday. Let's bring in Shyam Srinivasan. He's the Managing Director and CEO of Federal Bank. He's joining us right now to talk about how the quarter gone by has been. Mr. Srinivasan, thanks very much for taking out the time. How was the quarter for you operationally?
As you may have seen the numbers, we did have a very strong quarter. Operating performance was probably the best ever. Operating profit grew 30% Y-on-Y. And net profit is even better, 46% Y-on-Y growth. Both are all-time high numbers. So underlying business momentum, both deposits and credit grew 19% each Y-on-Y. Even sequentially, there was decent growth. Credit quality broadly okay. There are some pockets which have had challenges, which we've addressed. But the overall year, I would say, has begun quite a long plan. The outcomes, hopefully, if this trend continues, we'll be able to meet all our sort of stated objectives for the financial year, the return ratios, the growth numbers, the market share gain. So I'd say I'd characterize it as a reasonably good beginning on the back of, if you recall, a good Q4. That momentum continues.
The market was a little taken aback by looking at the slippages number, I think, which came at about 430 odd crores. Main pressure point being the retail segment, largely Kerala. But what's the outlook there going forward now?
See, I think there's one weakness in the system where people quickly extrapolate one quarter into four and say this is the number, and then the next number doesn't look like that. I would say that's probably inappropriate. At 400 crores has been the trend line for almost 5-6 quarters. Q4 was remarkably good, 275. So, you should believe that that may be an exception, not the rule. Around 350, 400 is where the run rates may be. And we think our full year guidance on credit costs of about 60 basis points is very much in the sight of the bank, irrespective of what happens in the external environment vis-a-vis some of the known stresses in the NBFC segment. So I'd say I wouldn't alarm or signal anything sort of nervous at this stage.
Okay. So in light of the retail segment, let's keep it to the growth of the retail segment. Do you expect that to continue to show a larger amount of growth on this base? And loan growth, do you expect to bring that back up to levels of 25% that it was earlier on from the current 19% that you recorded?
So I think the growth is a function of appetite and the opportunity in the market. I don't want to go into this, I'll grow at 25 and end up doing some mistakes. At this juncture, line of sight, at least for H1, looks like an 18-20%, with retail dominating the incremental growth quite nicely. I'm quite sure by last quarter of this calendar year or early last quarter of the financial year, some good big ticket opportunities may also emerge. But if you see the 20, 30, 40 crore exposures, that is still growing well. And I think we will continue to grow that. Because there are a few 200-300 crore large tickets that we are not renewing if the opportunity available. So to that extent, incremental growth will be strong, but growth will be strong. The incremental may have some offset. So I would look at retail growing at well north of 25, corporate and commercial growing between 17 to 18. And that blended will take us about 18-20%.
Mr. Srinivasan, a couple of industry-related questions for mid-sized banks. One, good morning, of course. One, would you say that it's difficult to chart out a 12-month, 24-month clean slippage stress-free environment in light of in light of the environment that we are in? It may not be a bank's fault, but one of your peers, DCB for example, has had some issues which were not there until the last quarter, and that may be because of the way the environment is. The SME sector is under stress, liquidity is still tight for some companies, and therefore the repayments may not happen on time. They have said that a couple of their accounts could slip into an NP any time. I'm not saying the two books are similar, but because these things could happen when you least expect it, is it difficult to chart out a stress-free course for the next 12 months, or it would be difficult to do that?
See, I'm not trying to be cocky, but generally when people believe that they can predict 2 years, they must be astrologers. I have always held the view, given any credit book, particularly if it's a very sort of widely spread across retail, SME, corporate, there will always be some wrinkle, but the overall balancing out is what you should see. That is where the management's capability to smooth out will be there with some, few percentage points here there. So I want to believe, and yesterday in my investor call, I've clearly said, we do have a line of sight over the next 2 financial years, as this one and the next one, and our commitments on return ratios are broadly something that we can hold to, because as we see, and we have sort of done some sensitivity analysis on the book, unless something sort of extraordinary caves in, we think we can deliver on those commitments. But will there be a quarter here there? Like, for example, we had a problem in Q1, as you pointed out, on the retail in one geography, because there were some discussions between the state government and the regulator on giving some dispensation on the moratorium accounts. What it does is it changes customer sentiment and behavior. Now, will that last forever? No. Will it last for a quarter or two? Yes. But can we even it out with something else? I would think so, yes. So the answer to your question, for most of us, big or small, ability to forecast for 12-18 months on the book in reasonably even circumstances is possible. Something crazy happens, then I wouldn't venture into it. But at this juncture, at least for us, we have a reasonable line of sight on how the next 12-18 months will play out.
Okay. You mentioned that you believe that the commitment to improving the return ratios would stand. So I would guess, because for you as a bank, the ROEs moving to that 15% mark would be a factor of a number of things, including the NIMs improving, the fee income improving, and the cost to income ratio coming off quite strongly. You think all of these would be possible to be delivered over the course of the next couple of quarters?
No, not a couple of quarters, Neeraj. I had said we were at 0.76 ROA 2 years back. We moved it to 0.88 to 1 to 1.12 to 1.25. So over 5 data points, we said this is what it will be. We are really at the midpoint and at 1. So I think the confidence that the last 2.5 years has delivered something, the next 2.5 may mimic that, and similar growth is what we are forecasting. As a consequence of ROA improvement, the rest of it is a really outcome, right? We believe that our fee income, as you would have observed yesterday, has grown 45% Y on Y, and these are not because of any large one-offs, more structural. We are not forecasting a massive jump in NIM, at best 4-5 basis points, and that will take us, and our cost income is improving quite steadily. It's now down to 49 something, and I had said over a 2-year period it will get closer to 48. So we are a sum of many micro improvements which will take us there. I am not making any big bang statement we will change the face of the earth in an overnight model. And I truly believe a more structurally balanced system will deliver, and we are sort of midpoint in that commitment journey. So I believe we are on course to delivering some of the objectives we have laid out, as in get to closer to 1.2, 1.25% ROA by FY22. Yes, 21 end.
Mr. Srinivasan, are there any large accounts that you're a bit worried about right now?
Yeah, I mean, there are accounts in the market that everybody, thankfully we are not in many of the names that are being talked of as very stressed accounts, airline, entertainment, we are not in any of them. We do have a couple of HFC accounts. We made some prudent provisions. These accounts are performing at this juncture. We don't know how it will play out over the next 2-3 quarters. So we'll start building a buffer for it so that it doesn't jerk our outcomes at any one point in time.
What is the proportion of those stressed accounts to the total loan book?
Our overall stressed book, if you take the net NPA, restructured standard plus what is sold to ARC, is now down to 1.67%. It's there in our investor deck. And that would rank amongst the lowest, I would think, in the market, amongst the more better NPA bank. We believe there are only 3-4 banks better than us in performance-wise, big or small. So I think we are in that. And this SMA2 book is also quite predictably low, at its all-time low.
Fair call, Mr. Srinivasan. Good quarter. Keep up the show. And thanks so much for talking to us at Bloomberg Quint today.